Good morning. Today is December the 6th. This is the Budget and Finance Committee. My name is Dick Rhodes, and I chair the Budget and Finance Committee. And it's 9 a.m., and we'll call the meeting to order. I'd like to have everyone that can stand and pledge allegiance to the flag. Okay, we have all of our committee members present. So we have established a quorum. We'll proceed to the approval from the minutes of November the 1st. Do we have a motion to approve the minutes?
So moved.
Second? So moved. Let's go right to item 3.01. Mr. Finelli, will you provide the October 2022 financials for us?
Thank you, Dick, and thank you, B&F committee members. Appreciate it. You guys know within your packet that the financials are published, and then we extract out the information into this presentation format. So any questions you may have in more detail are on that. Really impressive budgeting. I have to give our accounting staff who's up there. If you look at our revenues by every single category, look out to the right. You absolutely have less than $5,000 variance on every single category. In my time here, I haven't seen that once. So pretty impressive. So right at budget on revenues. Expenses, we did have some relatively considerable expenses for overtime. Todd is down in staff and in landscaping, and during the overseeding period, the overtime can be rather considerable. So that was the impact in that category. Also, in supplies and services, fuel for our golf course equipment and trucks and vans and vehicles are all a big expense every month, and the fuel prices have not abated very much in that arena. So overall, $100,000 deficit if you are over our expenses, mostly in labor. So the operating margin, as we said, we're right on budget for revenue, about $100,000 negative. So operating margin for October, negative $100,000. Moving to year to date, about $150,000 favorable. Mostly of that has been occurring throughout the year is in golf, as that's continued to be a very positive environment. On wages, despite the overage that we had in October, year to date, we're about $80,000 favorable on the labor line. Same issue on supplies with the fuel, but overall $140,000 favorable, which then when you combine the, so when you combine the 150 favorable on revenue and the 140 on operating, right now our operating margin about $290,000 ahead of after 4 months. Quick review over prior year. You'd expect operating revenues to be a little bit higher with the rate hikes we did in golf and dues and bowling fees and things like that. And so that's up about $100,000. Operating, I'll explain a little more detail on that, about $790,000 higher than prior year. So overall, we're down about $680 against prior year, but we knew a lot of that was going to occur because we did a considerable competitive wage adjustment in July, and increasing insurance cost has made against prior year about $437,000 on wages and benefits alone. Utilities and and inflation in our repair and maintenance, very unpredictable. And we talked about gas and oil, so in all other categories, about $400,000. So that makes up the vast majority of the expense notables against prior year. Moving to capital-related portion of the income statement, we've discussed APFs, and some of the decline in home sales has started to materialize into the income statement. So about a $60,000 shortfall in October alone. The realized and unrealized gains has had some pretty material moves in the first 3 months of the year. This last month was relatively benign at about 100,000 decline. So overall in the capital related, about 140,000 negative impact for October. Moving to year to date, as we talked about, the APFs are seasonal in the way we budget. So as of October, we're $80,000 down, but 60,000 of that was in October alone. So that category, I do believe, is going to struggle throughout the year as long as interest rates remain elevated. We talked about last month the unrealized gain and loss that was rather material in August and September. So $1,440,000 down through October, which comprises the vast majority of the summary, about $1,500,000 on the year to date against budget. Quickly to prior years, the APFs obviously were a stellar year last year, record setting, almost 1,600 APF transactions. So it's going to be a hard act to follow, and so that is starting to materialize itself as well, down $260,000. Investment income is increasing with the higher bond yields that comes with the unrealized loss that we've incurred. So that's the silver lining, that we are seeing more income as would be expected. So overall against prior year, like $1,500,000 down. So when we move to the, I don't know why this is stopping, there it goes. Quick detail of those APFs, we're almost 26% down. We do know that the rate was increased by $500, and we talked about the investment income, about $25,000 more per month investment income with the higher yields. So against budget, overall projected to be down $2.2 million. We're down 3.4. The big chunk of that is, of course, on the capital related. On the operating margin, there's the favorable 290. Against prior year, down almost 2.2 with the same items we discussed earlier. So shifting to our capital spend, closed POs through October, about 21,000 actual overage on, I think there's about 10 closed projects, but we're still projecting to be at or right very close to our $10.8 billion budget. The detail of that is, I don't know why this jumped ahead. There it goes. The yellow items are items that have been closed. So if you ever want to look and see what a specific project did, favorable or unfavorable, that will tell you. As we talked about, the budget was $10.8 million in the bottom column. 2 columns to the right of that, you can see we've issued POs of 10.2. And in the first column, projected variance shows that we're expected to be very, very close to that budget. And that occurs despite, up in the upper right-hand corner of this slide, the facts and findings for the parking lot. The governing board approved $75,000 more for that project due to stabilization issues. And that number is, if you look to the third line down in the projected variance, you'll notice that is a negative. So even with that included, we're still showing to be only right about $4,000 over. So there's savings throughout in other projects. Moving quickly to the allowances, 400,000 was allotted, 79,000 has been issued with POs. We added 2 this last month. There was post-construction remediation over at the Kuntz project that about a year and a half ago that was completed. But the joints were expanding and to prevent some water leakage from going in there. Carl requested this and we approved that issuance. Palm Ridge outdoor furniture, it's outside near the pickleball area. We had some safety issues. Many of the chairs had straps that were failing considerably, and we were just waiting for somebody to get hurt on that. So we did address that with that furniture expenditure. So as Cliff Swan, the county manager, talks about a lot, at the end of the day, the FFB percent is a very important one for you all to consider as you look at your budgeting, as you look at capital spending. And so we entered the year at 54%. At the very bottom, you'll see we expected to be at about 50% by the end of this current fiscal year. Where do we stand on the various items that are factors within the FFB percent? And that, first of all, was our operating cash, and that's 285 favorable through October. We are earning a little more on our investments, and the APFs, of course, are starting to demonstrate some deficits that we hope will moderate, but that one is of some concern as we go forward. Moving to projected outflows, the remaining unspent allowance, 321, and the closed POs right now is 21 negative, but we expect that to be favorable or very close to 0 by end of year. The reserve fund valuation change is $1.4 million down through October. And with all those factored in, we would expect to be at about 48% at the end of the year if things were to close the books right now. I will give one good update. It's not November's close yet, but since you all aren't meeting, I think till January 17th or something in that range, I thought I'd mention that November's reserve fund valuations with the moderation of the 10-year yield and the amount of bonds that we have in our portfolio, we've improved the reserve funds by close to $1 million in the month of November. So a good update before the Christmas holidays. So that's my presentation.
Pete, could I ask you a question?
Okay.
On your slide for the summary of the capital related, you listed realized and unrealized gains and losses, and with a loss in October of $1.44 million. Is that coming from our investments?
Yes, entirely.
Okay. I would like to make an editorial comment, and this is really for the benefit of everyone to appreciate what Pete just said. The FFB is projected to be 48% at the end of the year. I think that is a very important thing to understand, that that is in what we would consider, at least at a minimum, a red flag, that we're dropping. We knew we were going to drop, but I think when it really happens, you get that sense of realization. So from that degree, I would say that we need to be very vigilant, and as we are, and very aware of our financial position. Pete, thank you very much. Sure. Do any of the committee members have any questions? Any comments? Pete, thank you.
Sure.
Okay, we'll proceed into item 4.01. We have some policy reviews that we have some unfinished business. Policy review is FI04. Mr. Hobald, are you prepared to comment on that?
After carefully reviewing this, I could find nothing that stood out to me that screamed out for change. So if any members of the committee have something, we could certainly discuss it. I find nothing in that policy that requires change. The policy has stood the test of time. It's what I would call a mechanical type of policy. It describes step 1, step 2, step 3. I don't view that as something that's terribly strategic or requires any changes.
Thank you for your review on that. So for the record, we will, there is no change. The policy has been reviewed carefully, and we recommend no changes into it. The next one will be, this is a policy that was returned to us from the governing board for some revisions. Dr. Miller, have you had the opportunity to review that?
Yeah, I have. Yes, I have. After the policy was returned to us from the board, I went and sat down with the financial people, Pete Finelli, Cliff Swan, Kelly, and we talked about how we could clean this up a little bit. And the original intent was that the general manager has the prerogative to determine the methodology to be used to develop the annual budget, but it never seemed that that was really clearly communicated per what the wording in this was communicated to the board and to the B&F committee. So we cleaned it up a little bit. We struck out one thing where it talked about the format of the presentation, because frankly that just didn't seem to flow in the document, and added the section in here where we would again have a presentation that described the methodology, and you can read that there. Now, we went through several different iterations on this, and this is what we jointly agreed to submit back to the board for their consideration. So I think it just cleans up the language a little bit in terms of how we communicate, which is, again, something I think that's good on behalf of the community as a whole.
All right. Do we have a discussion on this? Did you have something?
Sorry about that. So I've got a question regarding 3.2. If I understand it correctly, the part that's highlighted would be an add to that section. Is that correct? Okay. So when it says that the draft financial plan, we get to see it by the end of February, and so that's the plan for the coming year that starts July 1, correct? The next sentence, the presentation shall contain at a minimum the methodology used, the previous 2 years' actual figures, and that's where, so the previous 2 years, would that mean the year ended June of 2022, or the year that we're currently in as part of that? Do you understand what I'm kind of asking?
That's a good question, and I honestly don't know the answer to that.
So could it be amended to say current or anticipated for the current year as well as 2 prior?
It could. Let me ask that.
One
Yeah.
simple change will make it all. Previous 2 years would be the fiscal year that ended. So in this particular instance, it's 21 and 22.
Mhm.
And if it was one change, just say, and the quote, and the projection for the current fiscal year, and you've solved it instead of the budget. And the projection for the current year would be my recommendation.
I think that's clear.
So, and I think the key part here is, although it appears that we're deleting a sentence and we're actually using about 90% of the verbiage from the sentence in paragraph 3.0. that is transplanted to paragraph 3.2. And then with the inclusion of the methodology and the look back to the minimum of the methodology used. So it's almost the same with the exception of the insertion of the methodology and the 2-year look back. Okay. And actually, I believe this captures the intent and the spirit of why it was returned to the B&F committee. They wanted clarity on when it would happen and exactly what is it that we wanted. So I think, David, you've done a fine job in that, and I see the improvement in this. So do we have other? Yes, Christine?
I think this is a small point, but it could be important. The word in the inserted sentence, right now it says the presentation should contain. The rest of the verbiage is shall, and I'm not an expert on the terminology, but we should probably change that to shall.
Shall.
That's a very different nuance. Is that all? Does that still capture your intention? All right.
So we will make an editorial change to change should to shall. Okay. Okay. Susan?
Yeah, I'm just, in terms of a change, we are going to include Pete's recommendation that this particular sentence also include a projection for the current year that is currently in process, because that really helps when you're trying. That helps when you're trying to analyze a future budget. Not only having the 2 prior years and the current budget, but also having that projected current year. We're only going to have maybe 6 months of financial data at that point. But as Pete said, they can project out to the end of the year for what we're doing.
Not only that, we intend to, you guys will all be part of the budget cycle. Frank, as you alluded to, February, let's just say it's the 20th, I don't know the date. You'll get the presentation, and then in that first iteration, you will see the FY23 projection. When we represent to the governing board, to your budget every month, we will update the projection to reflect actual. So by April, you will have had close to 10 months of before the board, issues their final approval.
So do we think that the wording is all right?
Well, excuse me, what is the actual wording we're adding about the projection for the current year?
I'm going to have to get together with Pete after this because I'm trying to take notes since I'm the temporary secretary and make sure that I've got his wording captured. It's hard for me to write and discuss and listen at the same time, so.
I can agree with that.
Okay, we won't be able to bring this to closure, so we're going to have to move it again until we can get this verbiage down. So we're going to defer this to the January meeting, and we'll do this again. Okay. Okay, we're going to proceed to item 501. It's the recommendation of an independent audit firm, and I will lead that discussion. The Budget and Finance Committee is required to notify the governing board of the independent audit firm that will be conducting our audit. We have to notify them by the 1st of January. This year, the audit was completed, and the firm that we have been using, and we've been using very successfully, their 3-year contract expires in June of next year. So it was time for us to look for a new audit firm, if necessary, or possibly to consider renewing the contract for our current firm. So we took this very seriously, and we did a financial audit candidacy search. Well, let me back up and say we have 5 people that we appointed to a task force. It would be myself, Mr. Bosak, Mr. Finelli, Mr. Swan, and Ms. West from the staff. We were able to identify 3 companies that were qualified and were interested in being our audit firm. We issued a RFP. In the RFP, we outlined the particulars, the technical responsibilities, and the operational things that were needed. And we conducted virtual meetings for 2 and an on-site meeting for 1. One of the firms was out of San Diego, and the other firm that we met with was here in Phoenix area, and the third was also a Phoenix firm. I want to talk a little bit about the scoring on this, but before we do that, I'm going to ask Gary Bosak to talk about the actual interviews that we conducted with the 3 independent firms.
Thanks, Dick. And I will say that any of these 3 would be very satisfactory. They're very professional. They came well prepared to have the conversation, as did we. The questions that we submitted to Pete, Pete culled through those and came up with a couple pages of questions that we would use, and of course being a little bit different for the incumbent than the other 2, but for the most part we were looking for similarities that would distinguish one company versus another, and also those characteristics within the company itself that would fit with Sun City West. And I think all 3 of those would meet. But just to quickly give you a flavor for what happened, the first company we met with was MPM, and they currently do Sun City Festival Trilogy at Vistancia, and they are one that you have a copy of the pricing in front of you as well in the packet from today. One of the questions we came at them right out of the box was, your initial quote is very competitive. What are the future increases based on what your averages have been for the past 5 years? You can see from above, they're at, in the first year, 45,000 versus CLA at 53,104, and then PKF at 62,700. So anticipating that they were maybe lowballing us to get a foot in the door, we kind of approached that very directly with them, and their increases, according to them, are attached to the CPI. So it was interesting that their increases in the 2 future years are 7.8% each of those years versus CLA, for example, at 2.8% each of the years. On another side, Pete brought up the fact that he thought the process that we were putting in place actually caught CLA a little bit off stride, but caused them also to rethink the budget amount that they were quoting, which was to hold the current rate. So from last year to the first year, they have no increase, which was very impressive from our standpoint. The second company was, you met Jean Dietrich at the October meeting when she made the audit response to us, and you can tell she's very knowledgeable and a very calm, professional individual. Interesting, the first comment she made before we were getting started was she was actually nervous, which you wouldn't expect to be, but she, being the incumbent, wanted to hold the line, so to speak. But she really did a very fine job of representing their company. Being the incumbent, their questions were a little bit different than the other 2. For example, one of the things that I particularly paid attention to was their RFQ responses. And all of those represent their companies as being the greatest on the face of the earth, of course. And so how you dig into the nits and gnats of that, it was a great team effort between Pete and Terry and Cliff on the literal side, the auditing, the accounting, the tax, and the regulation side. And Dick and I kind of did that from their corporate standpoint, and to get inside their thinking on how they should be entitled to do our business based on what their corporate values are. So some of the things that we tried to pin CLA down on was what best practices they'd learned. And we actually asked all three companies that. They deal with hundreds, in CLA's case, 9,000 different clients. So what kind of things have you learned from other companies that you would share with Sun City West to improve our operation? She was very complimentary of our auditing, accounting function in the community. And I don't think that was an attempt to avoid the answer, but she was almost ebullient in her praise of the professionalism and the attention to detail that our organization exhibits. But from my standpoint, the things in their proposal that struck out for me, innovation seems to be one thing that they value. So we wanted to find out what kind of innovative things have you done in other companies that you'd be willing to share with us. They have something called a seamless assurance advantage. And what that means in our parlance is they have a tremendous resource of people within their organization in each of those four categories that I just mentioned. So unlike the other two companies, CLA, if they get into a tax issue, has a tax segment of their company that they'll refer that question to. If it's an accounting issue, they've got a different group of people that'll deal with that. So the expertise and the specialization is pretty significant when it comes to CLA. Another thing that we were interested in talking about was the fact that they've been with us for, I've heard two different numbers, 14 or 18 years, but suffice it to say, a long time. And so the question was, after all that period of time, how do you keep the merits exciting? And from their standpoint, she was very quick to say that part of the advantage that they have, being local, they have a vast array of accounting people that participate in the audit, and they rotate them every year. So they don't send the same team of people back every year to get the same look. It's a different look every single year from a different group of people. The common denominator being Jean herself. And again, there's another level of organization above her that takes a secondary look at the results from the audit to make sure that nothing has been missed. So there's many sets of eyes that look at the results to make sure that we're on track. The last company that we had was in San Diego, and you could be reminded eternally throughout the entire presentation because they had the ocean in the background of either their home or their office, one of the two, I wasn't sure which. But one of the things that they amplify in their presentation was that any pending changes in legislation, they're always on top of and out in front. So we asked them if there were any that were impending that might impose their specter of negativism on us in the future, and they didn't identify any. So I guess that's maybe heartfelt that nothing is on the horizon, but as we know, things can change all the time. Something else we asked them about was their current expense is significant compared to the others. You look at the handout that you have, it shows that their first year is $62,750, then it goes to $66,500, and then the last year is $70,000, significantly higher than the others. In their presentation, or their proposal, they also allude to other expenses, which was a fairly generic term, which after we wound up grinding them into the ground on, we would pay for plane tickets, we would pay for lodging, we would pay for food, we would pay for all the extra things it takes to get somebody out here from San Diego to do their audit. So that will come into play when Dick talks about how we did the reviews, but quickly you could see that their financial side of things were not very competitive with the other two. The last thing I would mention is that they do Sun City. They do Sun City, and the process that they described in servicing Sun City involves only the general manager and the CFO. So all negotiations that took place between the company and Sun City involved two people, and I don't know that that's a very positive way to go. it certainly doesn't fit our methodology, and so that was another thing that we came into consideration of. So, in a nutshell, that's some of the things we talked about. Let me just make sure I don't cheat you out of some vast knowledge store of information. Another thing that PFK was talking about was the cycle and how we would fit into the cycle with them, because we're not a January through December company, and it would fit their purpose well. They're also thinking about putting an office in Arizona, which they don't currently have, as compared to the other two who do. I don't know that that is a differentiator, but it also was considered. I would also point out, lastly, maybe anticipating one of your questions, that this familiarity thing with CLA, kind of coming into it, you always view the incumbent as maybe having the business, it's theirs to lose. And from our standpoint, we were adamant about making sure that we weren't biased just based on their past performance. We wanted to challenge them to raise their steps to an even higher level. And so the familiarity thing is kind of a double-edged sword. You know them well because you've worked with them for a long time, but the other side is if you let them get lazy about it, which I don't in any way, shape, or form think that they will, it becomes a negative. So the appropriate conversation we had with them, I think, was not only enriching, was rewarding and spot on with what we were trying to accomplish. So any questions you might have about the interviews, Dick or I can answer.
Thank you for the, may I speak?
Yes.
Chairman. First of all, nice job. It's nice and tidy. The ranking criteria is not in my pack. I only have the pricing,
Right.
But
Dick's
it was
gonna,
online.
Dick's going to show that.
It was
Yeah.
online, so I was able to gather, look at it then. There it is. The first question is, were you able to, I'm sure you were able to get the size of the client base of each of these companies relative to nonprofits and HOAs, companies that are clients that you would say fit our, or close to our model and the kind of business, if you will, that we are in?
That's actually a really, really good question. I don't know that we got the size of the client base. Gary, do you want to come?
Yeah, MPM is a couple hundred nonprofits. CLA is over 9,000 nonprofits. And PFK is about 50 nonprofits. And I would distinguish the difference, just so we're all clear we're talking about the same. There's a difference between a not-for-profit and a nonprofit. And we're a nonprofit. And the difference, of course, is that the nonprofits can't take, I mean, they're tax exempt, and the not-for-profits make a profit, but they also pay taxes. So it's clear that they understand who their clients are.
Yeah, perfect. Thanks. The little factoids. Thank you.
Those are all in. Does anyone else on the committee have a question or a comment about Gary's? So when we, I think the bottom line is that what do we do with all this information that we have? And how do we make a decision on three firms that are professionally qualified and on all outer appearances have comparable capacity? We were very, we looked and decided that we wanted to have criteria that we would use in this. And if you note here, we talk about the accounting firm's depth of resources. You know, and by that we mean what type of internal resources do they have? Gary touched on that. He touched on that with some of the sub organizations within several of the firms and how deep would they get. We interviewed one of the firms, and their response to us on the question was, well, I would probably just tell you to go ahead and contact the municipality and let them tell you what to do. And so that one didn't quite score high in that particular category. Knowledge of the industry. And that's where Mr. Hobalt's question comes in. How much experience do they have with people like us, with organizations like us? Fee structure. It's pretty objective. We looked at the fee structure and we looked at it with a kind of an objective eye and then sort of the eye of the cynic. You know, what do we see in there that is not visible? And there was discussion on that. Competence displayed. How did the presenters come across? You know, because that's who you're really evaluating for that particular that interview. And they each one of them, with the exception of CLA, had two people there. Gary?
And important to note that the people who were doing the conversation are the people who will do the audit. So it wasn't something they would pass off to someone else in the organization. These are the people who would be on site working the audit.
And the overall value and fee structure. And so, in other words, we want to have value for what we're getting. We don't want to just necessarily go to the low bidder. So we did individual scorings, and this is really important that each of the member of the task force scored the interview blindly of the other members of the task force. There was no discussion in our group after the interview. We intentionally did that to make sure that we don't taint or amplify a particular company. We wanted all of the scoring to be done independently, and at the how that particular task force member saw that. So we went through, and you can see it's a pretty clear evaluation, quantitative evaluation. CLA was hands down. They came across by far in the highest. I think that PKF, if I could maybe read the tea leaves on that, I would say that it was a company that was very large, and I think there was a sense that we might be lost. And I'm not sure if they really wanted our business, although they voiced that they did. Maybe not. But and then MPM. MPM was a very competent company. We didn't think they were deep enough. They were a relatively small firm. I think they had in the neighborhood of 900 accounts in that neighborhood. And I don't think they had the experience in that would be comparable to what we were looking for. So our recommendation, the task force, is CLA. CLA is the one we are comfortable with, but notwithstanding that, they're also the ones that demonstrated the depth of resources, the knowledge of the industry, their fee structure, their competence, and their overall value. They weren't the cheapest, but we believe that they add the value that we're looking for. Gary?
One of the things that impressed us the most about them is they were the only one of the three who made the point that their role as accounting and auditing company helping Sun City West is protect us. And they had not only our management and staff, but the community best interest from a legal perspective. Their job is to keep us out of trouble, keep us in a position of making the right decisions, offer suggestions and alternatives when they think they're appropriate. And they were the only one of the three that approached it that way, and we were very appreciative of that approach.
Ann?
Thank you, Chairman Rhodes. I just wanted to add, I was on the Budget and Finance Committee the past 2 years, as was John Hobold, and Gary was on it last year, and Dick was too. But the question came up, I believe, 2 years ago about when would we next evaluate someone, because we were currently in a contract with CLA. And so I had approached Dick when he took over as treasurer that this was something we probably need to do. And to me, it's just a good practice to verify what you're doing is the right thing. And I think what we're seeing here, and I applaud the task force for all the work they did, and I know that's not an easy job after working on the financial advisor last year. But what I think we're getting is not something quantifiable, which is the cost, but we've got to look at the quality. And to me, CLA is demonstrating the quality, and they are showing that they've earned the right to continue. But I think we've done the right thing as a committee. We've done our due diligence in showing that we know that that is the correct choice. And I would fully support continuing with CLA.
Mr. Hobalt?
Another question, and this one is going to sound like I'm digging for dirt, but I would like to ask the staff that endures the audits, what was the biggest headache or problem they encountered in the last 3 years in dealing with CLA?
I'm actually going to go the other direction. One thing that was brought up in their fee structure, again, we spent an hour or more after we got their presentations. Cliff and Terry and myself met with the leaders, if you will, the audit presidents that were going to head up the audits, and talked a lot about how do they structure their actual audits. And we have some differentiations that already emerged from a staffing perspective to get all your audit requests to come through a portal, to have it well-defined as to, there's probably 150, 200 lines. Each one of them could take a ream of paper to respond to if it was a sample, policy updates, board members, things like that. To be able to upload that is just such a time saver versus the days when they'd come out and hand them the reams of paper. You'd be surprised that not all of them are at that level. And in fact, I won't name them, but one of them is more of what we call a shared file. That's not a portal. That's more of a data dump, and it doesn't really align with time savings and things like that. But item number 2 that was very, very important, and we dove a little bit into this, was I'd say at least once a month, if not maybe on the high end once every other month, we're consulting with them about an audit question, a 401k question, FASB changes and things like that. How are they going to impact our world? We pick up the phone and talk to CLA, and there's no meter clicking that says that's going to cost you $300 an hour to get an answer. As long as it's relevant to our audit, they do that. I wasn't absolutely certain that we got that same answer from the other 2. It was iffy, and I can't say they wouldn't, but it just didn't come across. We know the track record of them. Lastly, this is more the CFO and Cliff and Terry as well. And it's a little bit subjective, but you all, some of you that are on the B&F last year, we have an entry called the 606. And basically it involves deferred APFs. And when you get that money in, by your own policies and bylaws, it says that you're addressing R&R into the future. I won't belabor it, but it involves recording an entry at the end of the year to detract or add to the APF revenue recognized and impact the retained earnings. What does that mean? Well, CLA struggled with it in the very first year. It was a very profound, how do you account for this? They became experts at it in year 2. We sailed right through it. It may be subjective on my part, but when I asked the other 2 candidates about 606, One of them literally said, well, I'll have to research it and look it up, and that kind of concerned me quite a bit. So, John, to your question, I could go on and on. We talked to them a lot about the PPP loans 2.5 years ago. They were very, very profound in their understanding of, we know who are to qualify for this, and while you got the money under the guidance of some legislative prodding, you applied for it, but we strongly recommend you relook at that. And that was very wise to have refunded that, because there are some firms now that are facing, refund requests because they didn't truly qualify. That's the kind of service you get from these guys, and it's hard for me to say a lot of negatives about them. It's mostly, what do they do to help us?
Well, thank you for your very erudite answer. You obviously demonstrate a much greater knowledge and have personal experience with this than I could with my question, but you got at what I was after. How are they to work with? That's important too, because we have staff efficiency to worry about. We're paying for everything we have to do as well. So thank you very much.
Ms. Brown?
When exactly does our contract expire with them?
It is June of next year.
And so when would it be most expedient for us to go ahead and do we sign a 3-year contract? Is that correct?
We
Okay.
have.
We
historically
have,
done.
And that would have to go before the board for a
well, we have to make a recommendation to the board, and hopefully at this meeting, we'll be able to do that, and then we can forward it to the board's next meeting, the workshop on Friday, and then on to voting on the following governing board meeting. Mr. Bergnato?
Thank you, Dick. Given the overwhelmingly positive news that we're hearing, I think we should just move forward with CLA.
So let me, does anyone else have any comment? Let me just summarize. We had 3 professional companies that were interested in our business. We interviewed them. We made some objective and subjective assessments of them. I think if anything, CLA probably had a deeper hole to dig out of than the others, because I think sometimes we would be overly concerned when, well, what about the relationship we have with them now? Are we too comfortable? We addressed that over and over again, given the fact that, that how they rotate their staff and how we have the consistency of one person who, by the way, is a partner level individual, so she's not going to be swept up and put on a bigger assignment somewhere. So the task force overwhelmingly recommends that to this committee that we select CLA for our independent auditor. Do we have consensus on that? Can we start?
Yes. Yes.
Okay, we have unanimous consensus on that, and that will be forwarded to the governing board, hopefully for this Friday. Okay. Our next item of business is item 5.02, and we have 2 budget and finance policies, FY01 and FY02, and I'm going to defer that to Ms. Brown.
Thank you, Chairman Rhodes. The first one is financial policy FI01, which is accounting for capital assets. This was last revised in November of 2020. It says last reviewed then, but I do know that it was reviewed last year. And I've also checked with Carl Wilhelm, who, of course, does a lot of our capital projects. So there are no changes proposed for this.
Okay.
This particular, it's just a very short policy. It just has some definitions mainly.
Do we have any comments from the committee? Okay, and if you go to the next one, please.
The next one is policy FI02, which is capital expenditures budgeting. And this is where Carl Wilhelm really gets involved because he has presented our capital budget, as all of you have seen so far this year. This was last revised last January. Those who were on the committee last year may remember a few of the changes we made, but again, there were no suggested changes to this. Everything seems to be in order and still operating the same way, and Carl Wilhelm did review this also.
Okay, do we have comments from the committee? Okay, thank you very much. That concludes our business for today. I would like to ask if we, for committee comments from any of the committee members. We'd start with you, Christine.
No comments.
Mr. Bogdano?
No comments.
No comments?
No comments.
No comments.
No comment.
Excuse me. Our next meeting is for January the 17th. The meeting for January 3rd has been canceled. So at that, it is 9:56, and we adjourn the meeting.